The Sarbanes-Oxley Act also puts constraints on auditors. Again, remember, purpose of the Sarbanes-Oxley Act, or SOX, is to restore public confidence in the financial reporting system and public confidence in auditors. So some of the provisions of Sarbanes-Oxley that relate to auditors. Auditors' ability to render non-audit services severely restricted. So if I'm going to do the external audit of your company, I can't also provide appraisal services for you or actuarial services for you. There are limits on what other things that I can do for you. This is a big deal in Enron, for example. If I remember the numbers correctly, each year the company that was auditing Enron received $25 million for the audit of Enron and $25 million additional dollars for other things they were doing for Enron. It really tightened up the economic connection between Enron and its auditor. That just doesn't look good to people. People don't believe that the auditor can be independent in a case like that. So external auditors are prohibited from providing many sorts of non-audit services. Auditor partners have to be rotated every 5 years, again, to avoid this coziness between the company being audited and the external auditor. The external auditor needs to be above everything. They need to be independent. They need to be unbiased. I remember being with a partner who had been on an audit for a certain company for many, many years, and when he was talking about the company, he always said, we. He was supposed to be the external independent auditor, but he always thought of himself as part of the company almost. We. Now, got to have auditor-partner rotation every 5 years. That's according to Sarbanes-Oxley. An internal control audit. This is one of the most controversial parts of the Sarbanes-Oxley Act because it's been very costly for companies to for auditors and companies to implement. The external auditor must go in and say, let's have a look at your internal controls, your systems and procedures to safeguard your assets and to make sure that your books are complete and to make sure that everything happens in an organized and approved fashion. And the auditor has to sign off and say, yeah, we looked at that internal control system. See, you got to realize how revolutionary this is. Not only are we going to give an audit and an audit report on the financial reports themselves, we're also going to give a report on how good the internal control systems are inside the company. That's a requirement of Sarbanes-Oxley, the internal control audit. And finally, the Sarbanes-Oxley Act really elevated the importance of the audit committees. Board of directors, the general supervisory board of a large corporation, has to have an audit committee, and the external auditors are to report to that audit committee, and the directors who are on that audit committee are supposed to be outsiders of the company. You say, okay, what's the big deal? Board of directors is often composed of inside directors, so the president of the company and top managers of the company, so they work for the company, and they're also on the board of directors. And then there will be outside directors who work in different companies and only come together 4, 5, 10, 12 times a year to make high-level decisions or help make high-level decisions with respect to the company. These outside directors, the ones who do not work on a day-to-day basis for the company, they have to be the ones on the audit committee, and the external auditor needs to report directly to them. And why is this important? Because if the top management of the company is doing something that's suspect, the auditors, the external auditors, have to have somebody to report that to. Well, it's the audit committee of the board of directors comprised of outside directors. This is also a very important component of Sarbanes-Oxley. Auditors can't do certain types of non-audit work. You got to have audit partner rotation. Auditors have to give a statement on whether the internal controls are sufficient and whether that system is good. And also the audit committee has been beefed up and must be composed of outside directors.